You think a candle is just a candle. Well, if it's green, you should buy. If it's red, you should sell. A long wick appears, that means it was bought back, the market will reverse. In reality, it's not like that. Today I will explain what a candle really means, and you will be able to understand the logic behind candles instead of trying to find explanations in hundreds of thousands of patterns. I thought the same way when I was a beginner, that there was some kind of pattern and I tried to find it. For example, if there are 2-3 red candles, the next one will be green. Or if there are 4 green candles, the market will stop. That's not how it works at all. Candles are simply an indicator that shows a clash, a battle, and the result of the battle appears on your chart. Now I'll explain the logic in simple, plain language, so watch this video until the end. At the end I'll tell you how to become a trader quickly and easily today. We live in complicated geopolitical times, and it's easier to demonstrate all this using the example of military action, a battle. Imagine a front line. The front line is a dynamic concept. At first, one side retreats while the other advances. Then the opposite happens. And essentially, this front line moves like this. Now imagine that we add time to this front line. For example, the front line starts here, moves, and then the time of this event ends. Now let's transfer this to the market. You have a price chart. You have time on one axis and price on the other. And, for example, every 5 minutes the result appears on the chart in the form of a Japanese candle. In this case, the quote started here. The market went up, went down, then went up again, went down again, went up again, and here the quotes closed. You get a bullish candle. So essentially, a candle is a reflection of the actions of market participants, nothing more. But based on how this candle looks and in what context, we can understand a lot. For example, let's imagine this situation. The quotes opened here, trading began. The market fell, went down, and somewhere here, for example, trading ended. What do you see on the chart? Trading starts here, the market moves up, down, up again, down again, and ends somewhere here. And on the chart, you will see a Japanese candle like this. A Japanese candle has 2 elements, the body and the wicks. The body is the distance from the first price value during that time interval to the last price value during that same interval. A wick is a distance from the body to the highest price value, that's the bullish wick, or to the lowest price value, that's the bearish wick. The body is a sign of weakness because if the market, for example, was moving upward, reached a certain point, and buyers were unable to hold the price, what does that mean? It simply means that at the top, there were no market participants willing to buy at such high prices, and therefore the quotes moved down. There was simply no strong demand there. So if we see a wick, essentially this means weakness of market participants. If the wick is directed upward, it's weakness of buyers. If the wick is directed downward, it's weakness of sellers. Now let's imagine another situation. Here the price opens. For example, right here the market rises. Then it falls, and somewhere here it closes. What kind of candle will we have on the chart? We will have a bearish candle. The market opened here, went up to the top, then went down, and here such a candle appears. What will this candle tell us? It will indicate weakness of buying, because here we have weak buyers. Now I will explain to you the logic of how to understand strength and weakness. Now let's look together at the rough interpretation of what candles can look like. Let's take a zero line, meaning above it buyers dominate and below it sellers dominate. This is a candle without wicks, just one large body. This means that during trading the market simply moved downward. What does this tell us? It tells us about the strength of sellers. Let's analyze the next candle. Suppose it has a wick like this. What does this candle tell us? It still indicates the strength of sellers, because the wick is directed downward. But this strength is weaker because market participants were unable to capture new lower prices. That is, people simply refuse to buy at such low prices, refuse to buy cheaply. That's why the market bounced here, and that's why such a wick was formed here. Now let's suppose that you saw such a bearish candle. What will this indicate? The market was moving downward, reached a certain point, bounced and closed somewhere here. This clearly indicates weakness of sellers, because sellers clearly refused to sell. Moreover, buyers entered the market and began buying at low price. For them, unlike sellers, buying here is much more interesting. Suppose you saw such candle on the chart, a small body and wicks directed both upward and downward. What would you say? Well, I would say that this rather indicates the emergence of some balance, meaning that market participants are balanced. Because if we decode this candle, the market first moved down, then moved up, and somewhere here it closed. That is, we do not have clearly dominant sellers and we do not have clearly dominant buyers. And of course, a mirror situation. For example, we see the following situation: a small body and a large buyer's wick. Of course, this indicates weakness of buyers because they refuse to buy at high prices. This candle indicates that buyers are starting to weaken, but this weakness is not yet strong enough to make a decision. But this candle shows that buyers clearly dominate. Thus, by understanding and reading candles' bodies and wicks, you will be able to understand strength or weakness. But this still doesn't mean anything by itself. Most traders make a big mistake. Very often they set some level, some order block, and think that if we see a wick there, it indicates weakness. This is an incorrect assumption. Everything must be understood in context. Right now we have taken everything out of context. And an important element in context is the candle body. Because the body, just like the wick, can be used as a reference. Let's imagine the following situation. The market is rising, large candles appear. After that, the candles start to narrow. That is, candle volatility decreases and their bodies become smaller and smaller. What does this tell us? It tells us that buyers are refusing to buy at such high prices, because if they were buying, the market would obviously continue to rise. Suppose the market is moving down, and we see that the candles become smaller and smaller on the downside. The bodies decrease. What does this tell us? It tells us about the weakness of sellers. Suppose the same situation. The market is moving down. The bodies are large, but at the same time, wicks start to appear. What does this tell us? It tells us exactly the same thing, weakness of sellers. Because these bounces indicate that sellers are not willing to sell that cheaply. Now, I will ask you a question. Which of these situations do you think sellers will be weaker in? Well, obviously, you will say here. Yes, because the market is slowing down. And I will say no. I will say that sellers will be weaker here, because the wicks indicate strong, dominant buyers. The price was moving downward. It reached a certain point and sharply bounced. The bounce indicates that buyers started entering the market. In one case, we simply have weakness of sellers and no buyers. In other case, we have weakness of sellers and buyers present. So if we compare these two situations, in your opinion, where will the probability of a reversal in the opposite direction be higher? Of course, it will be higher here in this situation. Now let's imagine the following situation. The market is rising and large powerful candles to the upside start to appear. Is this strength or weakness of buyers? The market was rising before and then started to accelerate. Is this strength or still weakness of buyers? Of course, in the moment, it can be called strength. Otherwise, the market would not go up. But the context indicates that this is weakness of buyers. If the price starts to rise rapidly, it will very quickly reach levels where it becomes overheated, where market participants will refuse to buy. How can we understand that the market is overheated? You will see either candles with small bodies and a downward price impulse, or you will see the same thing but with wicks starting to appear. If we want to make money, we must understand context. We must look at the market through context, where all of this is happening, and analyze everything within context. Because candles are in essence just an indicator, just a reflection of what happened in the past. If you don't have time and you don't want to sit and analyze these candles and look for suitable trades to enter profitable positions, then I recommend that you join my trading club, which has been operating since 2022. During this time, we have executed more than 2,000 trades. Every day, experienced traders from our team select the best and most profitable trades on the crypto forex and stocks markets. The link to the club is in the description. To determine context, you need to open a higher time frame. How to determine which time frame you need to open? On a real exchange, the time frame determines only the frequency of your trades. The lower time frame, the more frequently you will trade, meaning your trades will last for a shorter period of time. If you're going to trade intraday, use the 5-minute chart as the lower time frame and the 1-hour chart as the higher one. If you are trading for a couple of days, that is midterm, then use the 1-hour chart as the lower time frame and the 4-hour or daily chart as the higher time frame. If it's truly institutional type trade, for example, if you want to hold for a week or longer, then use the daily chart as a lower time frame and the weekly chart as a higher time frame.